This is not about one bad Monday. This is not about a temporary dip that smart investors buy and patient investors ignore. What you are watching unfold across American financial markets right now, across the S&P 500, across the NASDAQ, across the portfolios of millions of ordinary Americans who did everything right, is the slow, grinding, systematic destruction of the confidence that held this bull market together for 2 years. And today's modest futures rebound, that tiny 0.34% green number flashing on your screen this morning, is not a recovery. It is the financial equivalent of rearranging deck chairs. The ship is still taking on water, and the people steering it are arguing about tariff percentages while the hull cracks. I'm Laura Bennett. This channel exists because the comfortable narrative always leaves out the part that matters most. We don't do optimism theater here. We do documents, data, timelines, and the financial consequences that get buried under the noise of one-day bounces and premature all-clear signals. If you are new here, subscribe right now because what I am about to show you is the clearest picture of where this market actually stands, not where the headline writers want you to think it stands. Smash that like button and drop a comment below answering this. Are you still in this market, or have you already moved to the sidelines? Tell me. I read every single one. Here is the argument I am going to prove to you right now. The S&P 500 is not in a rough patch. It is in a structural confidence crisis, driven by two forces that are not going away: artificial intelligence disruption panic and tariff policy chaos. And the market does not know how to price either one of them. When markets cannot price risk, they do not stabilize. They oscillate. Big down days followed by small up days, followed by bigger down days. The pattern repeats until something breaks or something resolves. And right now, nothing is resolving. This is not about volatility. This is about the slow evaporation of certainty. And certainty, once it leaves a market, does not come back. Because futures traded up 0.34% in the pre-market. Let me take you back. Not to this morning. Back to January 1st, 2026, 7 weeks ago. The S&P 500 opened the year with the wind at its back. Strong corporate earnings. AI optimism everywhere. The narrative was clean and powerful. Technology was going to reshape the economy. Productivity was going to surge. And the companies positioned at the center of that transformation were going to deliver returns that justified every lofty valuation. The Magnificent Seven were going to carry the index higher. NVIDIA was going to print another blowout quarter. The bull market was going to continue. That narrative is now in pieces on the floor. The S&P 500 has spent most of 2026 in negative territory for the year, 7 weeks in. A market that was supposed to be powered by the AI revolution is being eaten alive by AI fears. A market that was supposed to benefit from a business-friendly administration is being destabilized by tariff policy that changes week to week, gets struck down by the Supreme Court, and then comes back in a different legal wrapper 48 hours later. The investors who built positions based on the January narrative are now sitting on losses, watching the daily swings, and trying to figure out whether what they are experiencing is temporary turbulence or the early stages of something significantly worse. I am going to show you why the answer to that question is not as comforting as the bulls want you to believe. Receipt number 1. The number that the market cannot escape. The S&P 500 closed Monday, February 23rd at 6,837, negative for the year. Let that land for a moment. An index that opened 2026 at roughly 5,900 points, powered by record corporate earnings, AI infrastructure spending that was supposed to be the economic story of the decade, and consumer spending data that had economists upgrading their growth forecasts, that index is now flat to negative 7 weeks into the year. But here is what the headline number does not capture. Look at what is inside the index. The Magnificent Seven: Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, Tesla. The 7 stocks that drove the majority of the S&P 500's gains over the past 2 years are having a terrible 2026. Microsoft is down nearly 18% year-to-date. Tesla is down more than 8%, Amazon is down more than 8%. The Roundhill Magnificent 7 ETF is down nearly 6% for the year. The stocks that were supposed to carry the market are not carrying the market. They are dragging it. And Monday's session made it worse. IBM collapsed 13%. CrowdStrike fell nearly 10%. American Express dropped more than 7%. Oracle fell 4.6%. Visa fell 4.5%. MasterCard fell 5.8%. The financial sector as a whole shed 3.3% in a single session, its worst day since April 4th of last year. These are not speculative small caps. These are the foundational names of the American economy. When American Express and MasterCard and Visa are falling 5% in a single afternoon, something is wrong that goes beyond a bad news cycle. Something is fundamentally wrong with the confidence that prices these assets. But here is where I need to stop and make sure you understand what is actually driving this. Because there are two separate fear engines running simultaneously right now, and they are feeding each other in ways that make the situation significantly more unstable than a simple market correction. Receipt number 2. The AI disruption spiral that nobody knows how to stop. Last weekend, a research firm called Citrini Research published a report. Not a government report, not a Federal Reserve analysis, a private research note. In that note, Citrini laid out a detailed framework for how artificial intelligence could systematically displace workers, compress corporate revenues, and restructure entire sectors of the American economy faster than the market currently prices. It was not a fringe document. It was a serious, detailed piece of analysis that circulated through institutional trading desks over the weekend. By Monday morning, the algorithms had read it. And the results were visible in every sector that Citrini's framework touched. Delivery companies, payment processors, financial services firms, software companies. Every industry where AI could theoretically replace human labor at scale saw its stock fall as if the replacement had already happened. Not was going to happen, not might happen over 5 years, had already happened. That is what panic pricing looks like. That is what happens when fear moves faster than analysis. And here is the compounding factor that makes this AI fear cycle different from previous technology disruptions. In past cycles, the internet, mobile, cloud, the disruption was additive. New technology created new industries, new jobs, new revenue streams alongside the displacement it caused. The net effect was growth. The AI disruption thesis that is currently terrifying the market is different. It is fundamentally subtractive in its most aggressive framing. Not new industries alongside the old ones. Old industries hollowed out. Revenues compressed. Employment reduced. Consumer spending capacity diminished. If that thesis is even partially correct, not fully correct, partially correct, the earnings estimates that underpin current S&P 500 valuations are wrong. And wrong earnings estimates mean wrong stock prices, which means the index should be lower. Significantly lower. The market does not know whether the Citrini thesis is right. Neither do I. Neither does anyone. That is the problem. When you cannot price the risk, you sell first and ask questions later. And right now, a lot of very large, very sophisticated investors are quietly, steadily selling first. Here is where I need to pull back from the data for a moment. Because there is a human being in this story who is not a hedge fund manager, and not a quantitative analyst, and not a Wall Street strategist with a price target and a television segment. Her name is Patricia. She is 61 years old. She lives in suburban Columbus, Ohio. She spent 34 years as a middle school science teacher, and she retired 14 months ago with a 403(b) retirement account that she and her late husband built over 3 decades of careful, disciplined saving. Patricia does not check her portfolio every day. Her financial advisor told her not to. He told her to stay invested, stay diversified, and trust the long-term trajectory of American markets. He told her that volatility is normal and that patient investors are always rewarded. What Patricia's financial advisor did not tell her, what nobody told her, is what it feels like to watch your retirement account lose 4% of its value in a week because a research firm published a note about AI job displacement. and then lose another 3% the following week because the president announced a tariff policy that the Supreme Court struck down, and then lose another 2% the week after that because an AI company published a press release about a programming language. Patricia is not panicking. She is not selling. She is doing exactly what she was told to do. But she is watching the number in her account go down, and she is doing the math in her head. And she is calculating how much longer she can watch that number go down before the retirement she planned for, the one she worked 34 years for, starts to look like something smaller than what she imagined. Patricia did not cause this. She is not a speculator. She is not a risk taker. She is the person that the entire architecture of American retirement savings was built to protect. And right now, that architecture is failing her in slow motion. 7 weeks into a year that was supposed to be different. Now let us talk about the second fear engine. Because the AI disruption story is only half of what is breaking this market's confidence. Receipt number 3. The tariff chaos that nobody can actually trade. Here is the sequence of events from the past 10 days, and I want you to really feel the whiplash of this because it is extraordinary. The Supreme Court of the United States ruled that President Trump exceeded his authority under the International Emergency Economic Powers Act when he imposed sweeping reciprocal tariffs on imports. Markets rallied on that ruling. The legal framework was clear, the uncertainty was resolved, investors could plan. For approximately 72 hours, there was clarity. Then the Trump administration invoked a different legal authority, Section 122 of the Trade Act of 1974, and announced a new 15% global tariff on all imports, effective immediately for up to 150 days. Markets fell. The European Commission formally requested clarity on the policy. The European Parliament paused ratification of its trade deal with the United States. Gold hit $5,192. Bitcoin dropped below $65,000. Then the tariff that was announced at 15% actually came into effect at 10%, according to a customs notice from U.S. Customs and Border Protection. Not 15%, 10%. The number the administration announced publicly was not the number that actually went into effect. I want you to sit with that for a moment. The tariff rate that the President of the United States announced publicly, the rate that moved global markets, the rate that caused the European Parliament to pause a trade agreement, that rate was not the rate that actually took effect. In the same policy announcement, within the same 48-hour window, how do you build a supply chain around that? How do you model earnings estimates around that? How do you price assets in an environment where the policy that moves markets is not reliably connected to the policy that actually gets implemented? You cannot. And when institutional investors cannot build reliable models, they do not take risk. When they do not take risk, they sell equities and buy gold. Gold at $5,192 is not a sign of optimism. Gold at $5,192 is a sign that the people who manage the largest pools of capital in the world have decided that clarity is not coming, and they would rather own something that cannot be repriced by a Truth Social post. So here is the picture as it actually stands today. Tuesday, February 24th, 2026. The S&P 500 is negative for the year. The Magnificent Seven are underperforming badly. The financial sector had its worst single day since last April. The technology sector is caught between AI optimism and AI disruption fear and cannot decide which narrative to price. Tariff policy is changing week to week under legal authorities whose limits are being actively contested in federal courts. Gold is at historic highs. Bitcoin is falling. The 10-year Treasury yield sits near 4.04%. Not catastrophically high, but high enough to make every equity valuation conversation more difficult than it was a year ago. And against all of that, today's pre-market has S&P 500 futures up 0.34%. That is the rebound. That is what the bulls are pointing to this morning. Not a resolution of the AI disruption question. Not clarity on tariff policy. Not a fundamental change in any of the conditions that drove Monday's sell-off. A 0.34% futures gain driven largely by AMD jumping 11% after Meta announced a chip deal. One deal. one company, lifting futures 0.34%. And the financial media is covering it as stabilization. This is not stabilization. This is a dead cat preparing for the next bounce. Here are the 3 paths forward, and I want you to be honest with yourself about which one you actually believe.
Path 1.
The AI disruption fears prove dramatically overblown. Tariff policy clarifies within 60 days. NVIDIA delivers a blowout earnings report Wednesday that resets the narrative. And the S&P 500 finishes 2026 at or above 7,500. In this scenario, Monday was the capitulation event. The sellers exhausted themselves, the buyers step in, and the year-end rally that the bulls have been waiting for begins now. Patricia's retirement account recovers. The Magnificent Seven resume their leadership. Everything that looked like a structural problem turns out to have been noise. Path 2. The AI disruption fears are partially correct, not catastrophically, but meaningfully. Earnings estimates for 2026 and 2027 get revised downward across multiple sectors as the real-world impact of AI on revenue and employment becomes clearer. Tariff policy remains chaotic for the full 150-day window of the Section 122 authority, creating persistent uncertainty that keeps institutional investors cautious. The S&P 500 grinds sideways to lower through the middle of the year before finding its footing in the fourth quarter. The index ends 2026 roughly flat to down 5%. Not a crash, not a recovery, a grinding, demoralizing year that punishes the investors who expected more and rewards nobody except the people who went to cash in January. Path 3. The combination of AI disruption, tariff chaos, and the unwinding of Magnificent Seven valuations that were priced for perfection triggers a correction of 15% to 20% from recent highs. Not a 2008, not a dot-com wipeout, but a genuine, painful correction that forces a fundamental repricing of assets that have been valued based on a narrative. AI-powered productivity growth, resilient consumer spending, benign inflation, that is now being stress-tested in ways that are not going well. I want to believe in Path 1. The data keeps pointing toward Path 2, and the thing that keeps me up at night is the possibility that we are already 3 months into Path 3 without knowing it yet. Here is what I want you to take away. Today's green pre-market number is not the story. The story is that the S&P 500 is negative for the year 7 weeks in. The story is that the two forces driving that negativity, AI disruption fear and tariff policy chaos, are not resolved, are not resolving, and show no signs of resolving before NVIDIA reports Wednesday night. The story is that Patricia and the millions of Americans like her who did everything right and trusted the system that was built to protect them are watching their retirement accounts absorb the cost of uncertainty that they did not create and cannot control. The market will bounce today. It will probably give some of it back tomorrow. The pattern will continue until something breaks or something resolves. And the people on television telling you that the worst is over, the people pointing at 0.34% futures gains and calling it a recovery, those people are not wrong because they are lying. They are wrong because they are looking at the number and not the narrative. And the narrative, right now, is one of the most uncertain I have seen in years. Subscribe, because Wednesday's NVIDIA earnings are going to move this market significantly in one direction or the other. And you need to understand the context before the number drops. Share this with every investor you know who is tempted to read today's green as an all-clear signal. Drop a comment. Are you buying this dip, holding, or moving to cash? Tell me where you actually stand. The market gave you a small green number this morning. It has given you a lot of red numbers this year. Count both before you decide which one to believe.